So all three of you have mentioned interest rates. And so, it used to be if it worked at 8%, it kind of worked. I mean, especially when you were lending money at 3 to 4%, then you'd stress test it somewhere between 6 and 8, and if it worked at all those, it worked. We're now above 8% on a floating prime rate basis, I believe. So a couple questions. What are you guys testing at when you're testing debt service coverage, or when you're underwriting? What kind of interest rate scenarios are you using? And when you make loans, what type of interest rate protection are you requiring from your clients? And I'll start with you on this one.
Yeah, I'd say in the core buckets, it's we're a fixed rate lender there for the most part. And even before all this, and when rates were, if we were lending money at 3 or 3.5% there for a couple of years, we were still stressing it on the back end at around a 6.5% interest rate with a 30-year AM. And we really didn't want to go below, say, a 125 coverage on that number. And it was easy to do so because the rates were 3 or 3.5%. Right now, we really haven't changed that significantly. Our belief is really that when you look at the U.S. growth rate, if they can get inflation under check, and if you have a real growth rate of, say, 2%, and your inflation's 2%, well, that's 4% Treasury. Then you got the spread over that. Well, historical spreads have not been 250 over or anything. So we feel pretty good that that's still a pretty good stress constant. But we're seeing deals, the acquisitions today where you're lucky to get to a 50% loan based on that metric. On the floating rate side, we're really looking more at the exit caps and where we think those might go. And so if we're exiting somewhere around an 8 cap rate on the value of the asset, and we can get the debt out at a debt yield around 8, I think we feel pretty good about it.
Okay. And Tom, before you answer, you'd made the comment before when we were talking back there that I think I'd like to incorporate as well, because it's not just interest rates aren't the only cost that's increasing. Insurance has, for a lot of clients, I've talked to some insurance agents prior to this in their commercial book, and they're seeing an average of 30 to 50% increase per year. So if you're in commercial real estate, it's likely your insurance costs have doubled over the past 2 years. Obviously, personnel costs went up. So it's like the whole operating income side, the operating income
I'd say
increased dramatically. What does that do to your underwriting?
On that, I think we re-underwrote our multifamily book, like I said, and on average, rents outperformed where we performed them, which was great. However, taxes and insurance in most markets were, we missed on that. Those were high. Net, we're still probably where we thought we were going to be. But there's an example. We had a deal in DFW where the insurance was $500 a door, and they just re-upped their policy, and it's now $800 a door. And it was, a couple $100,000 to the bottom line. All of a sudden got hit there. And so we're seeing that across all of our regions. And I think, what we did, as a, due to that increase, we basically have a sensitivity now in all of our deals as far as like if expenses go up 5%, 10%, 20%, 30%, to figure out what the corresponding debt yield and DSCR and LTV are for those deals, assuming that expenses go up that much.
I know we always talk about it, Trek. We're big believers in DFW. We think it's the best market in the country to be in right now. And so when you read articles like in the Wall Street Journal about the state of the commercial real estate industry, there's one that comes to mind where they said nationally multifamily values have fallen 14% in the past 12 months, but yet it doesn't feel that way in DFW. I mean, you still see tons of Class A units going under construction. You still see tons of acquisition. Do you all look at this market in particular differently? Do you underwrite for DFW differently than you underwrite for other parts of the country?
I can start. We, when we're underwriting, we're looking at that entire, call it $100 billion book, measuring that all consistently. So we're not giving, even though Dallas-Fort Worth, amazing employment growth, amazing population growth, we are kind of benchmarking the entire portfolio at the same rate. And for us at Bank of America, typically we've been consistent across the board, 6.5 or 6% 30-year, 8.18 constant, which historically, I guess the last 10 plus years, that's been the benchmark we've used. That's increased to more like a 7.25 30-year, and so what that results in is about a 10.6 debt yield. Okay. So it's vastly different from where we were. And I wish we could give Dallas a little bit of a break, but we're consistent across the board.
Okay. Tom or Paul, any different?
I mean, I think we're very, very bullish on DFW. We've got a number of deals that we closed here. We're working on a couple of other ones right now in the preferred equity space, as well as on the fixed and floating rate side. So we're very bullish on DFW. I'd say, like, one of your questions on the underwriting side, we used to underwrite, we don't underwrite for better or for worse based on DSCR, we underwrite based on debt yield. Kind of the first question that we look at when writing a loan is, will we want to own it at this basis? It's not like our business, but that's kind of how we look at it. And so, we were underwriting high fives, low sixes, debt yields in most markets. I'd say that's moved up to 7.5 to 8 debt yields in most markets, and Dallas is probably like a 7.5. And you think, on a bad day, a multifamily deal trade 5.5, 6. So there's plenty of room between what our last dollar is and the kind of trade. So.
Yeah, I'd say our debt yields may not differ all that dramatically, but maybe the way we underwrite the cash flows do. I think Dallas has benefited from the growth, and we take that into account when we're underwriting. But we underwrite nationally on a very local basis, basically for that market, for that sub-market. But, insurance, taxes, everything else, where the rest of the country may not have the tax issue that we do. I would say, and there are people in this room that know this, if you're getting your tax assessed value, in early May, there's this window from like early May till July where it's really hard to close a loan on an apartment deal or a new property that just got reassessed because the initial assessments come out way taller than I am. And then they got to get negotiated down. But if you're an agency lender, or if you're anybody that's trying to underwrite cash flow, you're like, well, here's what it says, but we all know it ends up less. And it's just this mind game of like capital movement where it freezes for a bit. So that's a frustration maybe that we see here underwriting on a local level.
Yeah, I remember those frustrations. So Darcy, you've said a couple things that I wanted to circle back to. One, you alluded to the amount of debt maturing, and from the most recent statistic I read, it's I think we've got $750 billion maturing in the next 2 years, so $750 billion of debt maturing in the next 2 years. And then you alluded to some of the recent regulatory guidance that came out, which has been really positive, which sounds really positive because, to your point, only 2% of these are just refinancing. So I'd like to talk about that a little bit. Actually, let me start with Tom on it, though. Kind of what's the difference of working with an insurance company versus a bank versus a conduit in some of these scenarios? Or even the worst scenario where it's not just matured, but you've triggered a default somewhere along the way.
Yeah, I mean, I worked at Deutsche Bank for 10 years, and we had special servicers, and anyone in this room that's ever tried to do anything with a special servicer, good luck. It's you're calling usually some kid probably right out of college in Kansas City, and they have no idea about your deal, who you are, the loan, or whatever. Whereas opposed to a life insurance company, they actually have a relationship with you. They're going to pick up the phone. They're going to proactively try and work with you, and we're actively modifying deals on our side, on our life insurance book. And so it's night and day, I'd say.
Okay. Paul, any different?
Yeah, I'd say, the conduit business is more about the legal side and the servicer's agreements and the master and special servicer and all that. The life company side, you definitely have a relationship. And I think the communication has always been a little bit better on that side. Just the frequency of borrower discussions or asset reviews tends to be a little bit better.
Okay. I'm going to take a couple more questions, and then I definitely want to make some time to take questions for the audience, but I want to get a little further down in the weeds here. So the community, a lot of the community banks are struggling. Obviously, they are under, to your point, the ones $100 billion and above are under increased regulatory pressure. There was an article that said KKR and Blackstone Community Trust has made 0 new originations this year. So I guess the first question is, who's actually lending? It sounds like from some of the comments you've made, Paul, you guys are still lending, but I'd like to hear from each of you your appetite for new deals right now.
Yeah, I mean, look, we're still lending. We're doing bridge lending, construction lending, fixed rate lending, as well as preferred equity. And then we have a sleeve of capital that buys risk retention bonds and single asset securitizations. We're closing a data center deal right now in the market. So we're active on all of our programs. On the construction side, I'd say we probably have, For context, we did about $7 billion of lending last year. This year, I don't know, we'll probably get around 5 or so, but we're in the process of closing $1 billion plus of new deals across the country. So we're actively lending on all of our platforms.
Okay, good. Awesome.
Yeah, I mean, like I mentioned earlier, we have a large amount of maturing debt coming due, and we've worked through about half of that with our customers. And so it's pretty simple. If we're not getting paid off on, say, that $20 billion, we can't re-lend it out to the market. And so until we see some, stabilization, I think with cap rates and, with interest rates, it's going to be challenging, if not near impossible, to really focus on new originations. That being said, I do feel there's a misnomer in the market that we're completely shut down. That's not the case. We're just focusing and showing up for our customers on the maturities. There is a small, crack in the door that we are looking at new opportunities, but to my earlier point on the debt yield, it does have to fit inside that box, especially just considering all of the regulatory oversight that we're in right now.
Okay.
I'll let that one go. There's nothing really to add significantly there. I think they covered it.
Okay. So for the loans that are getting made today, kind of what do they, you talked about debt yields a little bit different, but what else is different structure-wise? Is it, obviously more equity in those cases, but are there other things that have changed that will make you a loan, but this is what the terms look like now?
Yeah, I mean, I'd say if you, ratchet up your debt yield from 6 to 7.5, that's going to just result in a lower loan to cost. So we were, call it 75, 80%, during 2021. We're now probably closer to 65 or 70% LTV, LTC, on stuff like that.
Across the board or specific to product type?
I'd say probably across the board. The other change in the market that happened, it was a short duration that it happened, but pari funding with the equity, that was happening on some deals, and we did a couple of those. I'd say now funding, particularly on construction lending, is now sequential funding, so we're seeing the equity's got to go in first and then the debt. And so that's another change kind of that's happened in the market over the last 12 months or so.
Okay. Paul?
Yeah, I think, as we put our money out, I think we're able to be selective. I think that the type of debt yields that we're underwriting today are very consistent with where we were before, but they're higher due to that stress test, as I mentioned before. But overall, I'd say spreads are up. We're lending very well, and don't really see much changing. I mean, it's kind of we're an averaging lender when you go year to year in the market, and I think that's just going to continue to roll. We've got a little bit over $110 billion of mortgages at this point. And that's a pretty consistent process of rolling and recapping and seeing things. But it's, every deal is a new deal. But we are being more selective today, I would say.
Yeah, I think it's probably a lot less competitive lending environment than it was 12 months ago.
And to Tom's point on leverage, historically, right, we would show up around the 60, 65% LTC. Now, given where we are from a debt yield requirement, that typically shows up as, maybe 45, 50, 55 on a loan-to-cost basis. So vastly different from where we were 1 year ago.
And I agree. That's the frustrating thing, is that you're looking at something and you say, okay, I can get to this debt yield that I've been lending on. But when you look at the overall capitalization of a deal, the borrower's like, gosh, I need a lot more equity.
Yeah.
But what's happening, though, is you get a lot, say maybe, we're coming out with mezz. And so we've come behind construction loans with mezzanine financing, which is kind of a new change for us, but we see that opportunity. And it may stay open for a while, may go away. Maybe it turns into preferred equity, which we would also be able to do. But it's the capitalization of the deal changes quite a bit.
Yeah, I'd say we've had a number of deals this year that we've closed where our last dollar from the credit bucket is whatever, 65, 70%. And then there's preferred equity